Thank you for tuning in to today's webinar, and I'm going to hand it off to Fiona DiDomenico of Castle Group.
Thanks, Shauna. Good afternoon and welcome everybody. Thank you for joining us today in the webinar. I know that we have a lot of questions that came in, so we're excited to get started, but we should probably introduce ourselves first. So I'm Fiona DiDomenico, Regional President with Castle Group. I think most of you are familiar with Castle, but for those of you that may not be familiar with us, we are one of the largest property management firms in the state of Florida. We have offices all across the state, and we specialize in communities where we can put a team on site. And most of our communities would be have lots of amenities. They might have food and beverage, towers, HOAs. It doesn't matter. We do it all. And thank you for joining us today. So, Steve, do you want to introduce yourself?
Yeah, good afternoon. Thanks for having me. I'm Steve Adamczyk. I am a partner at Varnum. I've been practicing in condo HOA law for about 16 years. Most all my clients are from Sarasota County down to Collier County, and I appreciate the opportunity to be here today. Obviously, we're post Hurricane Milton, but we're also still post Ian in a lot of ways, and so these discussions are relevant. Just appreciate the opportunity to join the discussion.
Perfect. And Nicole.
Thank you so much. I appreciate everybody being here today. I'm Nicole Johnson Pendergrast. I'm a partner with Hafer Company. I've been in the industry for over 21 years. We concentrate in the area of associations, developer turnovers, condos. We do about 1,000 associations. So I'm excited today to hear all the questions and be able to educate you on what needs to happen as a board member.
Perfect. Thanks, guys. And so as Shauna said, feel free to, at any point in time, just chat in your questions. We will be monitoring the questions. And we had a slew of questions that came in as well. But we thought what we kind of highlight today on our agenda here is kind of talking through or reviewing the association documents, right? What process do we go through after a storm has hit? Trying to assess what the costs are going to be for everybody. Chatting through, we got a lot of questions regarding, reserves and can I use reserves for some of the repairs that we have? When do I use reserves versus operating funds? So we'll talk a little bit about that. Also talk about whether or not the association, how do you know when you need a loan, special assessment, etc. Talking about votes and approvals that might be needed. And then, of course, considering CSRS and anything else that might be relevant to your particular association. And then what to be aware of, right? As you're trying to put all of this together, it's a lot of work. And as Steve mentioned, some of you were just literally recovering from Ian and had, just opened up amenities or got docs back working. And now we're starting back from scratch again. So with that, guys, I think we should just dive in. Steve, did you want to open up with maybe any of the questions that you had that were top of mind?
Sure. So a lot of questions I saw kind of trigger the emergency powers language. I thought it might be good just kind of delve into that for a second. And it's worth noting that both Chapter 718 and 720, so 718 for condos, 720 for HOAs, provide for emergency powers. And those powers are triggered when the governor declares a state of emergency for the area in which you're located. There's a number of robust powers. There's the ability to borrow without a vote of the owners, special assess without a vote of the owners, to declare certain portions of the property off limits, to declare certain portions of the property closed, to require evacuation for condominiums. And it's just important to know where those powers start and end, more importantly. The statute doesn't say these powers end when the declaration ends. They say the powers last for so long as is reasonably necessary to protect the health, safety, and welfare of the residents and to make emergency repairs. So depending on your facts and circumstances, you might still be in emergency powers for Milton. You're probably not from Ian anymore, and the declaration of emergency has long since expired for Ian. But ultimately, it's worth knowing that during this aftermath of a storm, we have these emergency powers. And I think one of the most important thing to note is that after a storm, when you do have emergency powers, you don't have to give full notice, right? So if the board says, well, we need to make a decision now on a remediation vendor, the statute says you only have to give notice as practicable. It doesn't say that you have to give a full 48 hours, it says you give 14 days. If you need a vote of the board to do something, you get it together as practically and efficiently as possible. You post it with as much notice as you can. But if you can only give 4 hours, you only give 4 hours. Right? You get the job done when you're in the aftermath of an event like this. So I just kind of want briefly just touch on that with emergency powers, and just noting that, again, they're triggered by the declaration from the governor. They last so long as reasonably necessary. And within those powers, there's a number of rights that you can exercise. And I'm going to go ahead and talk briefly on how that impacts reserves. And I'm sure Nicole will jump in as well from her perspective. And that
Before
we're
you go
routinely,
there, Steve,
Yeah.
sorry, I just wanted to emphasize a little bit, because I know sometimes boards and managers that are watching, they get a little confused, and you said something really important there, is that you still do have to notice, right, to the residents. It doesn't have to be the 48 hours or whatever it might be, but we should still be doing an agenda and still posting and e-blasting out and trying to make it as transparent as you can to the residents. And then one of the questions that did come in was asking about, we had a lot of associations that had their budget adoption meetings scheduled and obviously couldn't have them, or even their annual meeting. Could you speak to that a little bit before we jump to reserves? As to, I think the question specifically was, do they have to now, start the process over if it's an annual meeting and remail everybody, or can they just do an e-blast, or how does an association go about noticing either a budget adoption or an annual meeting?
Great question. And the answer to the first one, or the response to the first part of the comment, is yes, you always have to give notice. It's just that during emergency powers, it says we only have to give notice as practicable, right? So it's one of those things where you need to make a quick decision. You don't have to wait 48 hours. But that's not an excuse to only give 2 hours to, say, approve a contract to change the paint color, right? To paint something or to replace something. A lot of clients are like, oh, we're in emergency powers, we can use that to go do whatever the heck we want. And no, like, it has to be related to the, it has to be related to the storm. And the second part of the question is that the emergency power statute literally says that you have the power to, quote unquote, cancel and reschedule any association meeting. So if you had to cancel because of the hurricane, when those emergency powers are triggered, they give you the right to say, we're just going to go ahead and reschedule that budget meeting for 10, 15 days down the road. It would not require you to renotice everything, provided that it was noticed properly the first time, and provided that the decision was made when emergency powers exist. And so if I think Milton was on a Wednesday, if your budget adoption meeting was for Thursday, certainly you were within the right to say, we're not going to do this today. We're going to go ahead and wait 20 days. And the statute gives you the right to do that.
Perfect. Thanks for clarifying for us. And then I took you off course, so you were going to jump into a little bit of reserve discussion.
Yeah, I think this is a great topic that all of us can kind of chime in on from both an accounting perspective and a legal perspective. The word reserves does not show up in the emergency powers, right? I think it's worth noting. The most common question we get after a hurricane is, can we just use our reserves for whatever we want to, for remediation, for dry out, for removing wet cabinets and whatever? And the answer is not necessarily. There's certainly no blanket rule, but it's potentially that it might be available. So the very first part of the next part of the answer says, well, it depends on whether you're a condo or an HOA. Right. So if you're a homeowners association, if you're HOA, it's important to note that your default rule for reserves are that they're discretionary. Your documents may self-impose a restriction, but if you were only using statute, if you're only using reserves, which are defined as deferred maintenance expenditure accounts, which are your non-statutory reserves, the answer is yeah, you can use your reserves on remediation, cleanup costs, and landscaping costs because they're not restricted to use. So that's worth a conversation with your counsel for, if you're an HOA, whether or not you have statutory restricted reserves. Most of you don't, and you don't realize it. And so you could use those. If you're in a condo, if you have reserves, you can use those reserve dollars for their intended purpose, but you can't use it for unintended purpose because of emergency powers. Meaning, if you have reserve dollars set aside to replace the pool equipment and it gets ruined from salt water, you can use the reserve dollars for the pool equipment to replace the pool equipment. Why? Because it's there for the pool equipment. The useful life is now obviously 0, and whatever was there can be used to replace the pool equipment. If you, say, wanted to use the pool equipment money to upright trees and replace sod in your condominium, that would not be permitted because the emergency powers do not give you the right to just dip into reserves for anything you need. You can still use them for their intended purposes because that's why they exist, but they're not just carte blanche available for any need that comes as a result of a hurricane. And so I'd be curious for Nicole's take as well from the financials and kind of how you advise clients to work through those decisions.
There's a lot of miscommunication out there, and I'm glad you brought that up because we'll come in to do the audits and there was hurricane came through and we see that the reserves were taken out for operating expenses. And they say to us, well, we were told that there's emergency powers that we have the right as a board to use those reserves for anything and we can pay them back. And as you said, Steve, from an accounting perspective, the first thing I say is reach out to your attorneys because that's a legal question. But it gets written up in the audit because our understanding as auditors is regardless of its emergency powers, there's nowhere stating that the board can use them. So what sometimes they come to us and say, we'll say, well, first of all, can you get a membership vote to use those for other things than what they're intended for? And if you do, your actual funding is going to be different for your budget coming up because now you're going to be short in the reserves. So it's only a temporary fix because eventually when you go to do the budget, you're actually paying them back because the funding is going to increase. So regardless if you have it now, you're going to be paying for it in the budget coming up. So sometimes what I tell my associations prior to storms coming on, be proactive, have a line of credit set up, have something with the bank there that you're going to take out a loan. So if something comes up and you can't afford it, or you can't pass a special assessment immediately, use those funds from the loan temporarily, and then after the storm has passed, you can pass a special assessment to fund those. So I always tell my boards, we need to be as proactive as possible prior to a storm coming, because it's very beneficial to you that financially you're ready for those disasters or natural disasters coming through.
And I think there's just to add a little bit, we got a couple of questions coming in, so I'm gonna try and simplify it. So when a board, let's use, Steve, your example of it's a condo and the pool equipment was completely under 7 foot of floodwaters and they have to replace it. And they want to use the reserve money. The question is, well, what if it's a pooled reserve? So to determine, because in the old days where most people had itemized reserves, they could see all the different line items, but they would look to their reserve study, correct, to see what is in their actual reserve study to dictate what is in the reserve categories?
Correct. They would look to their the portion of the reserve budget which includes the components. So there's the budget might just have for a pool, it might have a figure on it, but ultimately there's a calculation somewhere that has the basis for that. Now, pooled reserves is like one big bucket, all right, with a bunch of labels on the outside. And as long as the dollar's in the bucket and the label on the outside somewhere says pool equipment, you can use any dollar in the big bucket, even though there's multiple components there on the outside of the bucket. So pooled reserves would be available to the full extent of the replacement, even if they wasn't fully funded based on the schedule. Now, obviously, you have to have a positive balance to be able to do this. And secondly, it doesn't mean that you're not going to pay for it. So just like Nicole said, if you overextend what you were going to spend on the pool equipment before you were ready to spend it, you're just going to have to make up for it over the useful life of the new component because you're short on something else as a result. Now, one little caveat there is that let's assume that we are not having the structural integrity reserve discussion. If you have structural integrity reserves, then you could not use the structural reserves for anything that's not in the structural reserve component. So the answer is kind of limited to the general non-structural reserves.
Yeah, that's a great point. Thanks for calling that out, because I think there is still some confusion out there regarding SIRS and whether you can vote to waive and all of that good stuff. So the SIRS, the best way to I think just remember it is you can't touch it. Right? It can only be for what it's intended for.
And same thing when he was bringing up about the pool is that I have some associations will say, well, we're going to add that line item in next year. Well, if you don't have it in this year, regardless if you put it in your budget for next, in your current year, if that item is not in there, it cannot be used for its unintended purpose, regardless of what you're doing next year.
And then, Nicole, I think you touched on this a little bit, but maybe we can expand upon it. One of the questions was, should I use reserves for the repairs if it's appropriate? Or do I just go ahead and get a loan or do a special assessment? What are
So
your thoughts? What sort of analysis do you look at from the accounting side of things to make that recommendation?
it's kind of a loaded question in some sense. What I mean by that is, so if you're fully funding your reserves and your association that's very fiscally responsible and you have the money in there and that item is in the component that you can use it, that's what it was intended for. So you budgeted. So when that item needed to be replaced, you use it. If you're not fully funding and you're partially funding those reserves, when that item comes due, you're going to have to sit back as a board and say, where's the money coming from? You haven't set it aside to fully fund that. So you're going to either have to pass a special assessment or you're going to have to take out a loan. And what you as a board have to determine is, and that's why a lot of my associations right now, before they take out loans, they're kind of doing surveys in their community and saying, would your community rather special assess and pay over a period of time to us or take out a loan and then we're going to pay interest on that? So it's something right now, interest, as we know in the last couple of years, has been quite high for associations to take out loans. So it's really a factor of what is your beneficial to your association. Some of our associations, they would rather pay the full payment and not finance it. The other side to that is some of your community might be able to afford to pay it up front and others might not. One thing you want to make sure you're doing is, and I cannot stress this enough, prior to taking out a loan and prior to doing any of the calculations, is that you reach out to your management company, your attorneys, and your CPAs. First of all, making sure, is there anything in your documents prohibiting you from taking out a loan legally? Is there any voting that's required? And then doing the calculation correctly. I've had associations where they've taken out loans, they've allowed part of the community to pay it up front, and then the rest of the community finance it, but then they're using the money from the owners that paid up front first, and they're not calculating the loan correctly. And what's happening is at the end of the loan, they're short paying it back. So you want to make sure you're getting everybody involved before you're doing all of this. Rely on your professionals. I cannot stress it enough, especially in emergency situations. Do not make decisions where you're putting yourself liable as a board member.
Yeah, it's a great point, Nicole. I think from the management standpoint, when someone asks me that question, there's, 4 or 5 real indicators, right, that we look at. So we look at your operating account and how much surplus do you even have in your operating account? And by surplus, I mean, what are your monthly, right, regular expenses that are recurring every month, just like you do at your own home, right? What is your nut that you got to cover every month? And then how much additional cash do you have? We like to see ideally, right, 2 to 3 months of
3
your
months.
operating expenses as a surplus in your operating account. Then, as Nicole said, we look at, if you're a condo, we're looking specifically, right, where are you with establishing those SERS account and where are you with your reserves? And we also look too at the demographics of your community. Nicole kind of mentioned this, right? Is this everybody's getting up and going to work every day and lots of families in the community, or is it a community where this is second, third, fourth homes? Those people might be more apt, potentially to just say, let's special assess and move on. So there's a lot of factors. So don't go it alone, I think is our message, right? It's really
Yes.
beneficial to take, what is that saying? Measure twice, cut once, right? And just kind of
Exactly.
chat through it and make sure the decision that, that you're proposing is the best one for the association.
And not every association is the same. I'll hear too many people say, well, this community down the street. Not
Yes,
every community is apples to apples. Amenities
that
are
is so
different,
true.
the amount of homes. So make sure you're not comparing yourself to another community.
It's a great point, Nicole, because I often say to my clients, you could have the exact same community built by the same developer next door, right? Identical footprint, identical, gallons, in the pool, identical workout facility, and it can even be staffed completely differently, right? So you
Agreed.
really have to just consider your association.
Agreed.
Yeah, Fiona, I typically measure twice, cut once, then put it on backwards. But this goes right back, and Nicole was mentioning about the governing documents. There's, financing is a really good solution for this, but there's 2 types of financing. There's the financing that's in place ahead of time and the financing that comes into play after the storm event. And so, the reason why you're on this webinar is maybe trying to figure out a financial solution after a storm event. If it's before the storm, like a line of credit's a great tool. But you have to make sure you check your documents before the storm to open that up. The board just can't run to the bank and open a line of credit. Oftentimes, your governing documents will say the association can borrow, comma, subject to approval of X% of the membership. So opening the line of credit is borrowing, right? So you don't want to necessarily run to the bank and open that up, because you're going to have to sign a resolution as a board saying that we've fulfilled all the necessary requirements. And you almost certainly will need an opinion from your attorneys, which say the association has complied with all of its requirements. So it's a great tool to have in advance. It's a great option for funding after a storm, because you don't have to worry about the underwriting. It's already done. It's already in place. But you need to make sure you follow your documents. Now, after the storm, again, the emergency power statute says if you can exercise emergency powers, you can borrow without a vote of the owners. It also says that you can special assess without a vote of the owners. And it says irrespective of your governing documents, which is obviously a really helpful tool. But after the storm, you're not always going to be in the best place to get documents together, to get financial statements together, to get human beings together to sign and approve things, right? Or the power to even run the Zoom meeting to get it done. So
Exactly.
the line of credit in advance is a really helpful tool. Now, again, emergency powers provide great discretion for these things afterwards, but the same token, it's a lot harder, and you might need that money a lot faster than the natural conditions of just post-storm living would facilitate. So one of our recommendations is look through your documents, work with your attorney, try to open a line if you can, just for those emergency expenses that you know probably won't be covered by insurance, and that are prone to be flooded or wind damaged.
Perfect. So we have a couple of questions, guys, that have come in. I think I know the answer to this one, but I'm gonna not get myself in trouble, and I'm gonna let the attorney answer it. So it says, can a condo board borrow from already collected special assessment funds, specifically for the state mandated work required by Surfside legislation, in quotations, for hurricane recovery and repairs? So basically they're saying they've already done a spa for some other work. Can they use that money to cover their current hurricane issues?
The answer is unlikely, but ultimately it's your lawyer's favorite answer, which is it depends, right? So the statute's very clear that special assessment dollars can only be used for their intended purpose, what you state on the notice of the meeting, and that any surplus must be either returned to the owners or applied as a credit towards future assessments. And that's in the condo statute, right? That's not, amazingly, it's not in the HOA statute, but it's in the condo statute. And so one thing to note is that you have to look at the notice of what you put on the document for the special assessment. If you put on the notice of special assessment that we're raising money to do waterproofing for the lanais, you can only use it for waterproofing for lanais. You can't use it for other emergency related matters. And so if you want to use those special assessment dollars, you either need to redo the special assessment or levy a new one, or levy a new assessment altogether and then use the surplus and credit it towards that new assessment. So the default answer is no, unless you have such a broad description in your special assessment notice that it could come under that umbrella, whatever you put on the notice of the document. Otherwise, no, you'd have to redo it somehow to make those funds available.
Perfect. And on that note, Steve, will you speak a little bit to the wording? So if they're going to do a new special assessment, let's say an association decides they're going to do a special assessment specifically to cover the cost of the repairs of Milton, what is typically the wording in that special assessment that they can put in so that the individual owners may be able to submit to their HO6 policy potentially a portion of the spa?
Great question. So when I practiced, I started beginning practicing law right after Wilma. So I was not practicing, after the last major hurricane event that came through our area. And so after Irma came through, I remember I had evacuated to Georgia with my wife, my 3 kids, 2 cats, and my mother-in-law. It took us 23 hours to get there. And I got a call from a manager saying, Steve, isn't there insurance for special assessments? And I started laughing at her. I'm like, there's no such thing as insurance for special assessments. What are you talking about? And lo and behold, there's this thing called loss assessment coverage, which for a condominium is at least $2,000 mandated by statute for any HO6 policy. And in homeowners associations, your homeowners policy typically has at least $2,000. I had 5 and I had no idea. And so what it is, it's literally insurance for special assessments levied by an association to repair damage to the common areas or whatever the responsibilities are after a peril that is covered by the policy. Now, that's the rub, which is that all of you are going to have wind coverage, which means that you will have special assessment loss assessment coverage for wind events. For flood events, however, the loss assessment will typically only kick in if you're carrying flood coverage. If you're living on the 7th floor of a condo building, are you likely to have flood coverage? Likely not. If you're on the 2nd floor of a condo or the 1st floor of a condo, are you likely to have flood coverage? It's much more likely. And so using the word flood in the special assessment notice could mean some people have coverage, some people don't. Now, I am not saying to be misleading on the special assessment notice, but using the word flood is going to trigger that analysis. And so you could be as broad and accurate to say things like damage to the common areas, right? Damage to the common areas and infrastructure. That's a true statement. And so that would potentially, I'm not saying help more owners get coverage that wouldn't have it, but it is accurate, and you're not automatically putting a trigger word that's going to require a much deeper analysis potentially by the underwriter from the insurance carrier. So do not be misleading, but you typically want to leave out the word landscaping, deductible, and flood from that notice.
Perfect. And of course, right, check with your individual association attorney, right? It's worth the call, because you
Absolutely.
could potentially, right, for all of your homeowners, help them, get
Yeah.
that reimbursement back. So
yeah, because the idea, just for those who haven't done it before, like when the board notices the special assessment and they adopt the special assessment, let's say it's $2,000 per unit, the owner should be able to take that notice and that assessment, give it to their insurance carrier, and then if you have the basic policy under a condo, your deductible is $250, and you get a check for $1,750, and you pay the association the $2,000 if that's what the special assessment is. So you're supposed to be able to get reimbursed from your carrier up to your policy limits for loss assessment. But if the event which causes the damage is not something you already have insurance for, you're not going to have loss assessment coverage for that special assessment.
All right, very good. I'm just reading through the questions, guys, to see, we've got a lot of them coming in, so bear with me 1 second here. We've got one asking about, can you vote to move money from non-Sears to Sears?
So there's a very long answer to that question, which is devoted to an entire webinar. So the question is, can we vote to move money from non-Sears to Sears? So what you're really talking about is the initial creation of the SERS, where you have received a SERS study, you got to put X number of dollars towards the structural integrity. Now, caveat, this is for condos only, and only condos of 3 stories or higher, right? If you're an HOA or if you're a 1 or 2 story condo, this does not apply to you. But for these new condos that are subject to SERS, you have to create this new reserve schedule altogether that has these components in it. Now, if you were perfectly funding your reserves in the beginning of time, there should be no difference, because the law has always been that a condo has to reserve for deferred maintenance or replacement costs that's $10,000 or more. Now, every item on the SERS has always been in your building, and it's always cost $10,000 or more to replace. Items like plumbing, electrical, load-bearing walls, those are probably never in your reserve study before. 99% of condos never had those in the reserve study. So if that's true, then your SERS reserve schedule, if you're like most condos, is going to have new components to it. All right, new components that were not already there. And so the argument is that if we take a dollar that was intended for the gym equipment first, and we're moving it into the SERS study, which now includes things like plumbing, electrical, and load-bearing walls, then we're using a reserve dollar for something that was never intended in the first place. So there is an argument that you need to get a membership vote to do that. Me personally, I don't think so, because the statute says that you must use these funds for their intended purposes, and SERS is a mandate of what you need to intend these dollars for. But you can understand that there's 2 sides to this. So your question is really, when we create the SERS, how do we move money and what proportion do we move over? Now, it's important to note that the statute, the admin code in your documents, and the DBPR has not told you how to do this. There is no bright line rule for how to do this. Some clients will do it pro rata. Some clients will do it all or nothing. Some clients will do nothing. Some clients will levy a special assessment to fund the beginning balance. All right, there's a lot of ways of doing this, but moving money from your non-SERS to your SERS most likely does not require a vote because it's always being used for reserve components that are intended by the statute. However, if someone wanted to get really aggressive, they would argue that, well, now we're funding for piping, which was never in the reserve components before. So even though we have pooled, there's something new. Therefore, you need a vote. I don't think that we have to go that far. And if that were true, then 100% of condos would need to have a vote. And I guarantee you 100% are not going to have a vote to do that. So the answer is most likely not, but there's a long answer to that question. You should fund your SERS. You don't have to do exactly what, let me rephrase that. You must coordinate for your SERS based on the most recent SERV study prepared. But the beginning balance funding can be in the board's discretion to some extent. Some do it pro rata, some do it all or nothing, some do, they pick a number out of a hat. So there's no bright line rule on how to do it, but you do have to fund it with something.
All right.
And
Excellent answer,
make
Steve.
sure that make sure
Go
that
ahead,
you're
Nicole.
talking to your reserve companies that are doing these SEERs, because you want to make sure the board, you're telling them what you want to move over. So if you want, you know, this portion of your reserves now in the non-SEERs to move into the SEERs, then they redo the calculations for both of the different components and reserves. So you want to make sure you're working hands-on with them, because I've had a lot of boards say, well, we didn't talk to them and we wanted more allocated, or we wanted more in the non-SEERs. Make sure you're working hands-on with them, because ultimately it's the board's decision where they're going to put the money and where the funding is going to come out to.
Right.
Those decisions, that's an awesome point, Nicole, and those decisions have implications, right? By not putting as much in the SERS as we want to, just recognize that you're going to have some components in there that were never there before. They're going to have a pretty short useful life, right? You might only have 5 years left in the plumbing and $0 to account for it. So where we move the money makes a big difference on when we need funds based on the items that are in the SERS and the non-SERS.
Yeah. I can't stress enough. I'd love to say that it was simple, and it's just not, right? Like there's a lot of moving pieces, and it'll get easier every year, right? As we do it year after year, but there's a lot to consider. And so for sure, right? Talk to your CPA, talk to your attorney, get all your, experts in a room and chat through it and come up with a good plan. Because whatever decision you're going to make now is going to affect the association, right? For years down the road. And Nicole,
if we're tying this to, sorry, if we're tying that back to the hurricane discussion again, like we mentioned earlier on the presentation, SERS can only be used for their purposes on that schedule under any circumstance after budget's adopted after this year. So moving forward. So, but ultimately, if you're looking for the flexibility, you're looking for those non-SERS dollars. In the SERS components, the flexibility is only within those items on the list.
All right.
Correct.
And then we had another question, Nicole, come in. It says, for COAs, isn't another way of preparing for emergency funding to simply have a line item in the reserves as general repairs or unspecified repairs and maintenance? Do you have any thoughts on that?
So if you're in HOA world, and as Steve pointed out earlier, most associations that are in HOA are non-statutory. So even if they have line items broken out, they can use those reserves for other items because they're not statutory. Condo world is different. Condo, they have to have statutory reserves and it needs to be specific. So if they're in the HOA world, yes, they can have a line item in there for basically deferred maintenance, they call it. And it's for any items that come up that they feel are reserved because they're not restricted. So they would have that flexibility in HOA world. Condo does not have that flexibility like HOA.
Yeah. And the reason for that is that the DBPR says if it's on your reserve schedule, it has to have a useful life and replacement cost. And the phrase contingency does not have a useful life or a replacement cost.
Correct.
And are you seeing any COAs putting some kind of a line like that then in their operating expenses?
I've gotten this question a few times, and Nicole, I'll let you go first. I've got some funny takes.
Yeah, I have in my HOA world, yes, I'll see a contingency line item. They basically call it contingency, it's their catch-all. So I do see that in condo world. I see it also. What I don't recommend is, and this is just my personal as an accountant, is that where they use that as a slush fund and they're putting such a high number on that when they're not really doing a detailed budget. So they're saying, you know what, we'll put 100,000 in our contingency because we don't want to detail our budget out enough. people don't want to see a slush fund. I think they really want to know what's going on and try to be as specific as possible. I'll have associations always ask me, is there a percentage that you put in contingency? No, there's no percentage. If you're fully funding your reserves and you're really looking at every line item in your budget, your contingency does not need to be that high because of the fact that you have everything for capital in your reserves and then you're budgeting everything for it. That's really for unforeseen things coming up or emergencies. But if you're doing everything properly, that number shouldn't be that high.
Mhm. It's a great point. In the operating side of things as well, clients are asking me, can we just throw $100,000 extra in the operating line item for rainy day, we'll call it hurricane preparedness, but and to your point, it's a slush fund and no one wants to see that. The statute says that the budget has to reflect anticipated revenues and expenses. And so having an overly large contingency is not reflective of anticipated expenses and revenues. Now, I think best practices dictates that you have to have something, or you should have some sort of contingency. There's no bright rule, there's no 3% rule or anything like that. And so it really needs to be kind of in line with best practices with your duty to foresee projected revenues and expenses. And, I hate to say what some clients will do is they'll just kind of gently overestimate all of their budget line items. So there's a little bit of a cushion built into everything. I'm not saying do that, but that is one solution
Right.
some people do. And then some people will have a modest contingency line item that everyone in the community can get behind as good practice.
Agreed.
Just going through the questions here. A lot of questions around what is like the magic number to budget annually for storm events. It's
I wish I had
literally
a
the
crystal
million-dollar
ball.
question, right?
Yes. I'd have a lot of money if I could answer that question, but
I know,
I mean,
yeah.
from an accounting perspective, I think the most important thing is, really look at this as, if you're a board member, really look at this like a business. And if you're really setting aside all of your capital funding, which is all your reserves, and you're really funding that 100%, and something goes wrong in a storm, you're going to have your capital items protected because you fully funded reserves. And then on your operating side, if you're really looking at and doing that budget line by line, reaching out to your contractors, and then having some type of emergency line item like a contingency, and as Steve stated, not an overly amount, I don't think you're going to have an issue. Most of my associations that plan that way and really look out to like a 25-year capital plan, they don't have the issues. The issues are the associations, I feel, what I've seen, are the ones that aren't anticipating for storms. They're not funding their reserves. They're saying, we'll special assess when it comes due. And then a major hurricane comes through and they don't have the money to do the work at that time because the vendors are going to come to the associations that have the money. They want the ones, and even having those line of credit open, that's a backup plan. If you are unsure of an emergency situation and you're doing everything correctly budgeting, have that line of credit open because that is there for those emergencies. And me as an owner, I would be more comfortable knowing you have that as a backup versus putting 100,000 in the operating and you have all this money sitting there that's not being used.
And eventually it gets used for a fountain.
Correct.
So it's always the fountain, just so you know.
Yeah.
And fountains always break, so.
I agree.
Okay, we've got another question here. Where does insurance come into the equation? Can we use appropriate reserves to pay up front and then replenish with insurance refunds?
Great question. So there's two components. That one is how do we pay the premium? I think I'm hearing, and then secondly, after the event. So most people, their insurance bill comes due before the end of the year because all those assessments pay the premium throughout the year as assessments are received. And so some people just say, I'll just borrow from reserves to pay the premium so we don't have to pay the interest on the premium note. And you can do that with the vote of the owners, right? If the owners allow you to do that first, you can use reserves for an unintended purpose this year, particularly. And so you can do that to fund the premium, and then you can pay the reserves back over time. That's the first part of the question, which we always get. The second one is, well, what about insurance after the fact? So the main function or the main variable is what's your deductible. a deductible is not some fee, right? People think of it as a fee. It's not a fee. Your deductible is your portion of the repair expenses until insurance kicks in. And so this is where reserves play a role in that. In that, let's say you have $1 million in your roof replacement reserve. And let's say you have $1 million deductible. And let's say you have a wind event which damages the roof. Again, you can use roof replacement dollars to replace the roof because now the useful life is effectively zero. But that's also counting towards your deductible. And so if you had $1.5 million of damage and $1 million deductible, you could use that $1 million towards the deductible, and then the insurance is going to kick in the second $500,000 to replace the roof at the 1.5 replacement cost. So you can use reserves for their intended purpose for repair and replacement following a hurricane event. And what you use out of those funds should count towards the applicable deductible. And then once you hit the deductible through either using reserves or special assessments or lines of credit or a combination of all those things, then the insurance kicks in after that. Unfortunately, the market is telling you that deductibles have to keep going higher and higher. They're no longer 1%, 2%, or 3%. They're mostly 5% or higher in most of the buildings we see, which means most communities will not get to their deductible unless there's a multi-hundred-year storm. And so that's obviously very frustrating. And so there's no self-insurance, there's no real self-insurance mechanism for condominiums. And so you're looking at that deductible as being, well, how do we pay for our share of expenses? And the way reserves fund into that is that you can use the reserves for their intended purpose. And the dollars that you spend towards those hurricane repairs from their intended purpose will count towards the deductible, which is helpful in some ways and completely not helpful in others.
And
Are
Steve,
you seeing, Steve? Go ahead.
sorry, go ahead, Nicole, go ahead.
Are you seeing, Steve, in your association, some of them putting it into a non-statutory reserve, this insurance deductible? Do you see that?
Yes, we're starting to see a little bit of that, but when your deductible is $15 million, it doesn't help very much.
Right.
And if, I don't know if I would say an association is lucky if they filed a claim and got, they actually did get a check back, because that would mean they had really substantial damage. But if they took the money out of the reserves to, repair the roof, and they actually did get a check back from the insurance, do those funds have to go back into the reserves? I mean, my thing would be they should, but do they have to?
From my perspective, the insurance company rarely ever tells you what the money has to be used for. They give you a check for the claim. And there's almost never a breakdown of saying you must spend X% of this insurance dollar on this component and Y% on that component. And so if you don't replenish the reserves, you're gonna have a zero balance and you just have to pay for it one way or another. And you've effectively already paid for it because you fronted the repair expense in the first place. So no, I agree with you, Fiona. Best practices would indicate that you should do something like that. I don't think the law mandates that you replenish the reserves. As long as your budget reflects a zero life and a zero beginning balance, you're paying for it one way or another.
Gotcha. Okay. We have a question regarding, Nicole, this is probably for you. They're asking, how do we represent the 2 to 3 months cushion in the ops budget? So I'm not sure if they mean how do they show that if they don't have it?
Sure, that's a great question. So the first thing is the 2 to 3 months in your operating side is in your equity side fund balance on the operating. So as long as you're fully funding reserves, the 2 to 3 months is considered financially stable. So you're going to go into your financial statements and look under operating and look at the fund balance. If it's 2 to 3 months, there's no issue. If you have less than 2 to 3 months, and remember, this is not required, it's a recommendation. There's nowhere in the statutes or anywhere in GAAP, generally accepted accounting principles, it's required. But if you're less than that, what we recommend is in your operating budget for next year, you build something in called working capital. You're basically putting into your operating budget an amount that's going to be left over at year end because you're not going to spend it, and it's going to increase your fund balance, because the more surpluses you have increases your fund balance. The way you get equity higher is having money left over at year end. And I'm not talking cash wise, I'm talking accrual. So the amount of income that you've brought in versus expenses that's been paid out accrued wise Whatever's left over increases that fund balance. So they'll put it in the income side called working capital. That will increase the maintenance fees and eventually have a surplus to increase that fund balance.
Very well explained. Thanks, Nicole. That's awesome.
You're welcome.
Another question, is there a max threshold for special assessments?
No, it's really the people paying with their vote in the next election for what the max amount is. But no, the statute does not say in the emergency powers, there's no cap on what you can special assess. In your governing documents under non-emergency times, there is often a threshold by which you need to get a membership vote, but there's still no max on what you can assess people. Ultimately, there's guardrails that are naturally just the market puts in place where if you levy too high of a special assessment, you're going to either price yourself out of your neighboring communities from that assessment, or people won't be able to pay it. So you have to get maybe creative and look at the nature of the community, but no, there's no limit.
Okay. And then we had a question about the gentleman saying it looks like they got a bill for their special assessment, but no explanation on the bill. I think he means maybe, or she means a coupon book that they got and there's nothing, it just says special assessment. They're looking for the backup. So typically, right, Stephen talked about that, it would be in the notice of the special assessment. There would be some detail in that notice. So I think that's where you would go back to find the backup for that.
Correct. So there should be. Now, it also under the new statute, along with that notice should have been a copy of a contract that was being funded with the special assessment dollar, which probably didn't happen for condos. So for our clients who do special assessments where they anticipate owners getting reimbursed with loss assessment, they'll typically have a cover letter, they'll have the notice, they'll provide a coupon, and they'll usually have some sort of spreadsheet which shows maybe what they're raising the money for. The adjuster at the insurance company is going to look at it with scrutiny depending on what they had for breakfast that morning. Some of them will just enjoy writing checks for loss assessment coverage. Others want to get down to the very, very, very fine detail. You don't know who you're going to get at the adjuster's desk, but most of my boards want to provide some more level of detail so that owners can turn it around. Because what's going to happen is the adjuster who had a bad breakfast that day is going to ask for the data. Then one owner is going to ask for it. And you're going to have 10 owners asking for it, and you have to do it 10 times. So you might as well just give it to them the first time up front in that notice package.
Okay. And then Steve, will you touch on, there was a question about who's responsible for the individual AC units on the roof that are damaged by a storm/hurricane?
Sure. So the condo, this is a condo answer. So 718.111.11 discusses insurance, and it was essentially rewritten after Wilma towards the 2011, which was codified. But there's a trilogy of arbitration and declaratory statements called the Plaza East Trilogy decisions, which kind of codified the world in which we are in today for condo insurance. In basic terms, in a condo, the association repairs and replaces what it insures. The owner is responsible for the cost to repair and replace what the owner insures. What you insure can be different from what the declaration says for normal wear and tear replacement. The original statute after Wilma provided that the unit owner insured the AC system, which meant that the owner would be responsible for the cost of replacing the AC system following a storm event. However, a number of years ago, that statute was amended to literally strike through the phrase HVAC. So by striking through that, it meant that the association now insures all of the HVAC systems, just like windows. Even though the owner might be responsible for windows during normal wear and tear, the association insures every single one of those windows. The same thing now is true for the HVAC system. Even though the owner might be responsible for the HVAC components for normal wear and tear or remodeling or just regular old, I want a new AC system, if it's damaged by an insurable event, 718.111.11 kicks in, and because the association insures those HVAC components, the association is responsible to repair and replace those components as a common expense. So the list of what owners insure, therefore what the owner is responsible for, is quite limited, right? If you turn the unit upside down, you shake it, whatever falls out is thought of as being kind of partly the owner's responsibility plus countertops and cabinets, right? So the owner's responsible for paint, countertops, cabinets, and personal property, floor coverings, wall coverings, So the owner's responsibility is quite limited, and it used to include the HVAC. Now, because it was stricken through by the legislature, it's insured by the association, which means it's treated the same as the roof of the entire building when you look at it in terms of who's responsible for what.
And you mentioned windows as well, Steve. We get a lot of questions on that. Windows versus sliders in a condo, the sliding patio doors. Do you have any thoughts there as far as are sliders also considered windows, or no, sliders are separate?
The answer is usually. So the way the statute works is there's 3 sections, and says the association ensures original construction and like kind replacement. If we're talking about the original sliding glass door, yes, the association insures the sliding glass door just like the windows. Subsection B, however, talks about material alterations that are approved by the board. And so this is when we start talking about lanai enclosures. And so that's really the relevant question, is that also the association ensures sliding glass doors that were maybe extended, or lanai enclosures that were extended with glass. There's another part of the statute which talks about the owner being responsible for uninsured expenses, but the coverage at least is there for material alterations for those lanai glass extensions. Subparagraph C is what the owner is responsible to insure, and there that includes, again, countertops, wall coverings, floor coverings, appliances, personal property. But no, the lanai sliding glass door in its original location will be treated exactly the same as the window in its original location.
Excellent, thank you. More questions coming in. We're going to run out of time like we thought we might, but we're not going to get to them all, but we'll do our best here. Questions about what is your opinion using public adjusters?
Well, Fiona, this is a good one for you to jump on, is, from a practical side as well, from your perspective.
Yeah, I'll tell you my thoughts. So there's a lot going on, right, with associations, especially the ones that got hit with Helene, and then 2 weeks later or 10 days later got hit with Milton. So depending on the level of damage that you have, if you're going to exceed your deductibles, we have some great public adjuster companies that we work with that can be very beneficial. And typically their cost is about 10%. They can help with making sure the remediation companies that are on site, right, are doing a good job, that they're not overbilling. They know exactly, right, on average, how many blowers you need, all sorts of things that you, as a property manager, or you as a board member wouldn't necessarily know and do in your everyday work. So they can definitely be a great help. But like anything, there's 2 sides to every coin. So Nicole and Steve, I'm going to let you guys talk about maybe other sides of the coin.
I mean, from my perspective, a lot of my associations absolutely use them, but there's good and bad. So like you said, there are some ones out there that you have to be very cautious of. I always tell my associations, either reach out to your management company if you have one and you're using them, which we always recommend you should be, or your attorneys that know the ones that are good or bad. Because you just don't just go out there and go Googling somebody that does this and hire them to do your association. Take it serious and reach out to the people that use them and see the ones that are good.
Right. The statute caps their emergency recovery at 10%, which is why you see that. I found them to be very helpful after Ian, because it was the first time that I can recall where a lot of these buildings were just damaged by both wind and flood, and trying to discern between the two, what was covered by what policy. Now, the unicorn is where the insurance company can't wait to write a check, but 99% of the time, they can wait to write a check, and you're not going to agree on what you're owed. And so the adjuster with their industry knowledge can be extremely helpful. I find you run into problems where you don't look at the contract. And so the question, well, who fronts expenses for those consultants, which charge a lot of money because they know they're going to get reimbursed from the insurance company? Who's going to front the cost for the destructive testing and those reports? Does the association have to repay them if there's no settlement? Like, how clear is that language in the contract? You're talking about potentially hundreds of thousands of dollars of expert costs that someone's going to be paying for. And the other thing to keep in mind is that, they're incentivized to have a big claim. You're incentivized to have a big insurance recovery, right? As the insured, you want as much insurance as you can get if it's an insurable loss. However, when you get a little too greedy, the insurance company typically fires back with, this is fraud. And when you hear that word, it means they're denying coverage altogether. Not just how much are you entitled to, but you're not entitled to anything. Your coverage is revoked. And so getting too greedy can oftentimes lead to a lot of litigation and prolonged recovery. And so working with the right adjuster, if it's appropriate, is critical, because when you get in the right sweet spot of the appropriate aggressiveness and industry knowledge, it can be very helpful. But getting too aggressive or not knowing what you're doing with inexperience can likewise be damning in a lot of ways.
Yeah, it's great. I think it goes right. If it's too good to be true, it probably is, right? That's the good, ground rules. And use vendors who are, referred to you by your industry professionals, right? So everyone on this call has used great public adjusters, and we'd be happy to, connect you with whomever you need. Couple minutes left, guys. We have an HOA question that I wanted to get to. Steve, this is probably for you. It says, if your documents state that the HOA is responsible for repair and replacement of roofs on villas, but the HOA insurance is carried by the homeowner, can the homeowner file an insurance claim for roof repair, or are they prohibited since the HOA is responsible for the roofs?
So I'm not saying that the question is wrong, but in almost all the documents that I've read where you have shared roofs on an HOA and the owner is the one insuring the roof, it's because the documents will distinguish between insurable loss versus routine wear and tear. So the documents probably say that the owner is responsible to contribute any insurance dollars received before the association has to pay anything when there's an insurable event. And so that's probably the way the documents are written. If the documents are not written that way and it just says the association is responsible to repair and replace, the owner doesn't have an obligation to file a claim because it's not their insurable interest. The association has the insurable interest when it's damaged by an insurable event. So I would recommend taking another swing at the documents, and you'll most likely find that there's differentiation between that roof when there's an insurable event. Now, the most common problem is when the association's not involved and the owner insures the roof, and you have a shared roof and one owner has coverage and the other one doesn't. And one person says, I get to get a new roof. And the other person says, I don't even have insurance. I'm not paying for half of it. My roof's just fine. So that's when the documents become more important about how are we going to resolve that dispute. There's usually addressed in the documents somewhere, but that's the shared roof problem. I bet you if you look at the documents closely, you'll find that distinguishing feature somewhere.
Perfect. And one more HOA question. It says, our docs stipulate that after an act of God, the HOA must replace all original trees that were planted by the builder, which is unusual. I haven't come across that, but they say now that we have had 3 storms, residents are questioning this portion of our documents. Our insurance obviously does not cover landscaping, and that is where most of our damages come from.
Maybe consider amending that provision, right? Maybe seeking an amendment to that provision, because the reality is that you're going to present a proxy question where you're going to say, if you vote in favor of this amendment, we don't have to spend $5 million on trees. If you vote yes, or if you vote no, you're going to be getting a special assessment to replace people's trees. And people who have fine trees are not going to want to subsidize their neighbors who lost a tree. So that'll probably be a popular vote.
Okay, very good.
Great.
And I think we'll end on one last SIRS question. Because I had this question come up 3 or 4 times, so I'm going to ask it. It says, in initially adopting pooling for the SIRS reserve, does that require a board vote or a member vote? It's a bit of a loaded question there.
It's just both. All right. So the board determines whether or not they even want to think about using pooled reserves. The membership has to vote to open the door for the board to walk through. That threshold is now a majority of all the units. If you have 100 units, 51 must vote yes. The DDPR has sort of clarified that pooling will be available, but if you don't have pooled today and you want to have pooled SIRS, the switch requires a vote. If you already have pooled because you've already had the vote, you don't have to have another vote, in my opinion. But if you're trying to go from straight line to having a pooled SIRS, you have to have a vote. Would you agree, Nicole?
Yes, I would agree. That's exactly what we're telling our associations.
Yeah. And that's a vote of the membership, not of the board.
Correct. Now, the nuance here is that even if the members authorize it, the board could still say, forget it, we're doing straight line, we don't care. But ultimately, you have to have that membership vote to open the door for the board to then walk through and adopt the budget, which uses the pooled reserves if you're coming from straight line.
Okay, excellent. Well, guys, we're right at 1 o'clock. Any parting words of wisdom, Steve and Nicole, for our everyone that's joined us? We had quite a high participation today, so lots of great questions.
I think the most thing is, I tell everybody, and I hear all the questions, is they say, show me the money. You need to know where your money is. Where are you
Yeah.
making your interest? Where are you going to fund the reserves? Start talking to your financial people and your attorneys to figure out where the money's going to be coming from.
My parting wisdom is touches, communication touches. I find my best run communities are the ones that make things inevitable. And if you're considering a special assessment, you want to have so many touches that this is coming that it's inevitable. The surprise, oh, hey, turns out we need a big special assessment, is only going to bring frustration and questions and discussions of transparency and whatnot. The more communication touches you have of inevitability, I find it runs much more smoother. And most people are understanding when it comes to post, hurricane situations.
Yeah, those are great points, guys. And I can say from my standpoint, I think one of the challenges for board members and finance committee members is, you guys are in it every day. You're, getting hundreds of emails, you're seeing the invoices, you're talking to the attorney, you're talking to the CPA. You have to sort of take your board member hat off and put yourself into the resident's chair, who you've been doing all this work on their behalf and they've been oblivious to everything. So to Steve's point, right, really taking a step back and almost over communicating and breaking it down, because it's logical. You have to give them the logic and the why behind it. You guys know the why, but being able to explain that to the residents. And listen, we all know, no matter what, you're not going to please everybody, but if we can explain it logically and lay it out and be very transparent, it makes it much easier, for everybody. So on that note, on behalf of Castle, thank you so much, you guys, for spending time with us. And Steve and Nicole, thank you for all the time you've invested today. We really appreciate it. And I know that everybody on the webinar appreciates it as well. Thanks,
Thank you for
everybody.
coming, everybody.
Take care.
Great seminar. Thank you. Bye-bye.